markets are getting hammered. And of course, we know from the Fed minutes the other day that there's a lot more hawks in the Fed than there is doves, and that rates are not going to stop going up. And this is kind of a game that they're playing. And I think this is leading into the digital currency world. But inflation is not under control. We don't have people working. We're more in danger of stagflation right now, which would be obviously the worst. High prices and nobody working, because the jobs numbers, which we'll see next Friday, are going to be garbage as well, because the jobs that we're seeing are part-time employment, not full-time employment. So you have a inflation number which is still well understated. And I can tell you that I don't go grocery shopping a lot, but when I'm in Vegas myself, which I have been, my bill is 40% higher over the last 6 months. So you can do that, and that's buying the same exact products. So inflation is, the 10-year notes are probably going to 6%, which puts mortgage rates at about 10%. This is a terrible time to buy if you're going to buy housing. I mean, housing's going to collapse. We haven't even scratched the surface of what I think the collapse is going to be. This is going to be, in my opinion, a repeat of 2008. Okay, now, 6 months from now, a year from now, you might have the greatest values ever once again. Because remember, housing value is no longer determined by the house itself. Housing value is determined by the cost of money. And the cost of money is rising, so housing is falling. In the meantime, a house you could have bought 6 months ago and you're going to pay X for per month, you're going to pay X for less now. Because and the people aren't selling as quickly because, of course, they think their house is worth more because of what it was worth 6 months ago. It's a money game, and it's a dollar game now, not a true market game. Because when I had my first mortgage, it was 13%. So I think what you have to look for here is housing's going to fall, and I think you'll probably see 20-30% lower price than they are now. And the key is save your cash and be ready to pay for it without having to borrow, because you'll get a heck of a value. You have to remember what the value is, and again, money changes. The higher interest rates, actually the lower value of housing, just because it's purely, we're a by the month society. How much is it by the month compared to my paycheck? That's what we're watching, and I expect to see housing. I mean, it tipped off here in Vegas not that long ago, before rates even started rising. You needed to qualify for a 7% mortgage. Now you need to qualify for a 9% mortgage. And already the new construction, because it was is slowing, and now they're making deals on houses that haven't been built yet. That tells you that there's a big problem, and that the banks are in deep water once again, even though they keep promising us and telling us that they pass every stress test. I think that the banks are too over leveraged. I think that during COVID they gave them the green light to go well over the mandate of 10-1 in lending. And again, the scam of the Federal Reserve and the scam of banking is that the banks borrow from the Federal Reserve. That's the lending rate. And of course, they can take that loan, which is actually a liability, and then turn it into an asset and then lend out 10-1. So they're actually paying for that loan that they took through the money that they're lending out. It's a real scam game that they play, and that is allowed to be played by the Federal Reserve, because of course they have the American taxpayer to bail them out once they go bust again. Listen, I think the last time we talked, I told you I thought equities were going down 50 to 70%. Okay, I have not changed my opinion. We're up a little bit for the year now, but I'm not surprised. I mean, we had a down year last year. You get always some early buying in the year. I think we're now seeing, we're breaking down some very key levels right now. And if they hold, I think that we're going to be 50 to 70%. I have not changed my point of view there whatsoever. I cannot time it. I wish I could tell you a timing. Now, again, for me personally, I'm always long, no matter what I say, and I'm always hedged, so it doesn't really matter. But my trading positions are all short. And I think we're starting right now. The breakdown through 4,000 S&P was a pretty big number. And I think we'll probably next stop, we'll test 3,900, but I think you're going much, much lower. Listen, those are going to be big rallies. Bear market rallies are the most vicious that you can get. They look the best, and of course, those are really great selling opportunities. The stock market is going to continue to sell off, I believe. The metals, I think what happened is they got a little bit too far ahead of themselves. We go back about 3 weeks from today. Okay, you saw that gold had made a near-term high and then just collapsed. And I think what happened is the buyers got too aggressive and there was nobody left to buy. So now you're having some pressure going on. And, I do think that gold is going to find a bottom here somewhere. and I think it's going to go a lot higher. I do think that gold will make new highs this year. So I think that gold will find its level and its bottom and make some highs. And of course, we're having a little bit of a rally in the dollar right now. And not that I'm a big fan, I don't like to really correlate the assets, although they are correlated. Short-term correlations don't mean anything. I think gold will probably find a bottom, maybe as low as 1,800, a little bit lower, and then it would look to go higher. But certainly, if you're a physical buyer, as I am, I don't care what I pay for it. I know it's going a lot higher over time. Well, I think the dollar is going higher right now as it still stands as a reserve currency, and the troubles around the globe and the finagling with the fiat currency system itself is so fraudulent because there's nothing backing any currency. It's all central bank chit chat, right? So it's your turn to get hammered. So no matter what the number of the currency is, what happens is it's still worth less, right? So, that's part of the inflation. That's part of the taxation without representation. They do it through the dollar. They do it through other asset classes. So Americans actually have to pay more money, even though it seems like they're making. It's not a present road ahead. I think you do have to stay invested in the market, though, if you can afford to. I mean, first of all, the money invested in the stock market should be money that you can afford. Okay, it should not be your emergency spending. It should not be your mortgage or your car payment. It has to be money that you can afford to have in that market. Okay, and then you can use derivatives to hedge that so that you limit your risk down to a small percentage versus people buy and then they get too nervous and they start selling. You don't want to sell. Remember, it is time in the market, not timing the market. So what you want to do is figure out how to use derivatives or options, and what I use. I have a whole program that does it automatically for me. So it trades constantly. When markets drop X amount of percent, it rolls down the hedge and buys more. That's what I think that people need to learn how to do so that they can stay in the market and protect themselves and not have the fear of it going to zero. Well, listen, all I can use is the evidence that I have, and the evidence that I have is for 150 years, the markets have gone up 8.5% year over year on average. So I can't ask for more proof than that. From the history of time, we've had an increase of 8.5% year over year, not every year. So, are we going out of business? The only quirk that would come into the markets that would change, that would make this time different, is if we become a socialist nation, which we're headed that way, but we're not there yet. Okay, you destroy capitalism, you're destroying this country. That's this administration is doing a hell of a job trying to do that, and that's one of the things that we have a problem with. But based on history, I can only base that 8.5% has been the number no matter what, through 87, through 2001, to 2008. We're still on the same average. In fact, since 1950, the average gain is 10% year over year. You can be a stock picker. I think that's fine if you like some companies that you find value in, but you want to make sure that those companies have value, that you believe they're going to be in business 10 or 20 years from now. Or you can use, the indexes, which is a safer bet. They do pay some small dividends, and they are a much bigger blend. The indexes are nothing more than mutual funds that are, that trade openly, that you don't have to wait for fills and do your thing. They're very liquid. So I do both, but if you can find a value stock that you like an Apple, for example, at a reasonable price, hey, what's wrong with that? It's a company that makes money. They're not going anywhere. Verizon, any of those types of companies that have been around forever and will be around forever, most likely, is what you want to have. You want to have a company that's, you don't want these speculative companies like a Beyond Meats or something like that doesn't make any money. Make sure the company at least makes money. I would not borrow on my house at these rates, nor would I sell my house at these rates. I think that you're selling into a hole and you're selling into a panic. If you're planning on moving, then it's a wash, right? You're selling it at a discount, you're buying at a discount. But if you've got a low rate mortgage, which most should, okay, that's not one of those adjustable rate fancy deals, okay, that's flat, then I wouldn't. If I'm at a low rate, I'm not doing anything. I'm standing pat. I don't want to borrow new money at higher rates.